What's up everyone, and welcome to today's video. In this one we're going to be going over breakers, how to use them in context, and defining them in terms of PD arrays rather than just entry techniques. So I wanted to clear up any misconceptions around breakers as well, and we'll be doing that all in one. So first of all, we have to start off by defining a breaker. Firstly, we have a high. This is for a bearish scenario, I should mention. We have a high, a low, then a higher high, which takes out the liquidity from this high, inducing retail to go long, and takes out their sell stops from their shorts. So we create a high, low, higher high, break past down this low, and then you take however many successive down close candles are here. So in this scenario it's 2. I've just labelled it out as 1. Once we break past this low, we want to see it traded back into, and as you can see in this example, it trades to the pip, and then obviously we want to see it trade away. So that would be your entry. I like to put my stop above the succession of down close candles rather than a swing high up here. It will give you much better risk to reward, and I wouldn't want it to trade past this sort of area anyway. And then as you can see, we tap into it by the pip. Price breaks lower past this low. Order block gets respected. Down, and then this rejection block here gets respected twice before breaking lower down towards sell side liquidity down here. So just back to defining a breaker. High, low, higher high, and then lower low. And next we'll look at some bullish examples used in context. So now I wanted to go over a key misconception I often see in terms of breakers and clear that up for any of you. So in this bullish scenario where we take out the low, we have low, high, lower low, and then a higher high. We trade into the breaker and it runs away, which is pretty simple, right? However, it doesn't always look as clean as this, yet they're still breakers. So for example here, we have on GU the same chart, we have a high, a low, higher high, and then technically down here, as it trades down here past this low, this becomes our breaker. However, notice how it doesn't look as clean as the last one, which is fine. By technicality, because we take out this high and then break down below this low, this is still a breaker. So all of this price action in here, once we've broken down below this low, is still trading inside our breaker. We keep this in mind whilst looking for a trade. So let's say we were trying to go short around this area. We keep in mind the fact that we're trading inside a breaker, which adds more confidence to our trade. We can also then look inside here, this area here, which is a balanced price range, extend it out in time, inside the breaker which we already have, and then I would take a sell there simply because of the confluence first of the breaker, and then also a BPR inverted gives us our sell. So that's 2 confluences there, and trading's all about probability. So the more confluences you build, the better probability your trade is of not being a loss and actually hitting targets. So this bit will be slightly more advanced, as I wanted to give some context to breakers inside of market maker buy and sell models. So if you aren't familiar with market maker buy or sell models, I encourage you to head over to ICT's YouTube channel and check some of his content out. So if you are familiar, then we can break this one down. So we're here on USD CAD monthly chart. As you can see, price had a big retracement from this swing and this swing down towards a discount, and we had a rebalanced, redelivered price range here, which was traded into on the monthly, and then we have buy side liquidity resting up here. So retail have their buy stops and stop losses up here. After we've traded into a PD array, this is what I want to aim for. So our MMXM, since we have the PD array, and then external buy-side liquidity on the monthly time frame, our market maker buy model will present on the daily as such. So dropping down onto the daily time frame of our market maker buy model, this grey box here is our PD array, and you should be able to see the original consolidation up here of the market maker buy model, which is the terminus of the move. So have this marked out in green, price rallied up, returned to consolidation here, distributed and distributed again into the PD array. We then created a high, a lower low, and then another higher high. And then what's this? This becomes our breaker. So we can use this in context of market maker buy models and sell models. We have a breaker here into the PD array. And why do we expect this fair value gap inside here to hold? Because it's trading inside our breaker block. Created the breaker, fair value gap inside our breaker, which adds what? Another confluence. That's two confluences as to why a price should react here. You can either take buys here, maybe with your stop underneath the body of this order block, or even head down to a smaller time frame and then find another market maker buy model inside this fractal. Then you should notice another breaker inside this bit of price action here. Pause the video and see if you can point out where the breaker is. I'll give you a couple seconds. So you should be able to spot it around this area here. A low, higher high which takes out this high, break lower past that low, and then trade above. And then these two candles, or this down close candle I should say, up close, sorry, my bad. We pull back and trade inside this. We have a fair value gap which we are actually currently trading inside this on the day of recording. So we'll see if price wants to break down lower or actually react like we think off of this fair value gap inside the bigger breaker. So this is just an example of how context behind breakers can actually increase the probability of your trades. So just to recap really quick, we have an overall bias which is from this PD array on our daily time frame. We want to, every time we tag a short-term low, we want to look to trade higher towards this. So once we tag a short-term low, what can we expect? As we're bullish, we can expect price to break higher, and then because we now have this pattern, trade inside the breaker only to head higher. So in upside moves, every time we tag a short-term low like this, we now know that it's not heading lower, it only tagging that low to actually expand higher, come back, and then expand to our actual target. So let's take a look at a final example of how to use breakers in context with a narrative and then frame them around market maker models. So GBP USD 15-minute chart. Down here we have a true gap, which I would use as a draw on liquidity we'd like to trade into. We also have this low resistance liquidity down here. So price runs up into a PD array on a higher time frame, trades back into the order block here and breaks lower. We then have a BPR here, which is left once we trade from that order block. Now we take liquidity from these highs and leave another high here before breaking lower, and then 2 AM New York time, which is London session, we trade above this high and into the balanced price range here. So this is a 15-minute balanced price range traded into, and once we traded into that BPR, what did we do? We took a high here into it and broke lower. Now what do we want to see happen? We want to see more displacement, and then this area used as our breaker, because why? We have a high, low, higher high, broke lower with displacement down to a lower low. Price comes back into the breaker formation and then moves swiftly away from it. This would be an entry with our stop loss above this sort of area, and then as we continue to break lower deep into London session, as you know, we're targeting the gap down here, break lower leaving a fair value gap inside here, and then I'll take you down to the 1 minute of this price action here before we reach our target, and show you how breakers can also be used as fractals. So we have a higher time frame breaker on the 15 minute, which as we break lower past the breaker, we can use a 1 minute breaker as well to reach our target and refine our entry. Now onto the 1 minute chart. Remember, this grey box is our 15 minute fair value gap, which was created as we move down. So we put in a high as we create the fair value gap, move lower. At this point, the 15 minute fair value gap is there. So we come up, trade into it, and run away massively. This massive downside move is what we want to see. But notice this line here is our actual gap, which is our draw on liquidity. We don't actually take this draw on liquidity yet, because why? There's a breaker inside this price action here, and again I want you to pause the video and see if you can spot it out. Okay, so we have the high, the low, and then as we trade back into the 15 minute fair value gap to mitigate that, break lower, this pattern down here becomes our breaker. Notice how we wick, come into the breaker really quickly, which could be our entry, and is the same reason we don't expect a big retracement into here, because we have the breaker formation. So price doesn't have to come back to a premium in order for us to sell. Take a sell there, stop loss either above there if you're more conservative around this area, and then run straight to the target. This is the 1 minute chart, but this can be used on all time frames. If this was a daily time frame, it would be the exact same thing. People may be expecting price to retrace to a premium, however it doesn't need to because the breaker formation is there. And that brings us to the end of this video. I hope you found it informative and useful. If you did, be sure to like and subscribe, as there's more content coming in the next few weeks. Be sure to turn on post notifications to stay updated with when I upload. And I hope you find this useful. I'll catch you in the next one. Thank you for watching.